Welcome to the Corporate Venturing Insider Series, where I interview top practitioners in the CVC world and learn with you the best practices and golden nuggets that they have accumulated over their career. In this episode, we will be learning from Kirsten Bartok, Managing Director at AirFinance Ventures. Kirsten, could you take a few minutes to share your story and how you got to where you are today?
Sure, Nicholas, I appreciate being here. I'm excited to talk with you today. So I guess I grew up in an entrepreneurial family, was always entrepreneurial in that aspect, and then attended the University of Pennsylvania and majored in economics and political science. And there definitely got exposed to the world of finance through the Wharton School and classes I took in that world. And after undergraduate, was lucky enough to get a job at Goldman Sachs in their investment banking program. So spent a few years in their investment banking division, and then also in debt capital markets, and found that I really enjoyed the finance aspect of corporate investing in businesses and how essential it was capitalization and growth to a company's progression and long-term success. So after Goldman, went on to business school out west to Stanford Graduate School of Business, and was lucky enough there, being in the heart of Silicon Valley, it's hard not to be exposed to all the interesting things happening on Sand Hill Road in the world of venture capital and the explosive growth happening in technology. So focused there for 2 years with definitely an emphasis on venture investing and technology investing, and spent a year at Broadview Capital. They had a venture firm in their arm, again, another corporate venture, but within an investment banking firm. And then after business school, went and worked for Hamricht and Quist at their venture arm. We had a $350 million, I would say, mid-stage growth equity fund that was doing, at that time, which was still early, Series C and Series D venture rounds in technology startups. And H&Q, again, for some of those who may not be as old as I am, was a three horsemen on the West Coast at the time: Montgomery, Hamricht and Quist, and Thomas Wiesel. I'm blanking on the third, which is awful that I forget it now. But they were really the three boutique investment banks that catered to the technology startups. I joke it was a Wild West in the late 90s when I got there. And there was a lot of collaboration between investment banking and investing and research, which probably wasn't as fully allowed as it would be today. But at that time, we were hearing the investment bankers were out recruiting, looking at early stage companies, and we were doing thematic investing at the time. The internet was just taking off. It was 1999. So spent a couple of years there, and I had a wonderful mentor, Charlie Walker, and he was fabulous and helped guide me. And again, one of the things you learn about investing is that it truly is a mentorship business, that it's hard to learn on your own. It's hard to learn from the corporate side, but you really need to get that apprenticeship from sitting on boards, understanding how to structure term sheets, and really learning by doing. And that's what we did there. So after a period of time, we actually got acquired by Chase Capital, and that we became even more of a corporate venture capital firm, where we were able to look at fintech and technologies that were being incorporated into the bank at the time. Today, as we look at fintech and crypto and all of that, it was just starting in the early 2000s, but it was really core and central to where Chase was going, and we were able to test out technologies that were taking off at the time. And this included, of course, middleware, because we were really at the advent of the conversion from the server-based software to cloud computing and the migration out to the edge, which we would see come to fruition over the next 20 years. I laugh today at having such a long-term perspective in technology in the venture world. In my world today, I do mostly emerging technologies in aerospace, defense, space and communications, logistics and transportations. But things I'm seeing now have so many similarities, because there were many investments we made back in the early 2000s, which would eventually come to fruition, but we just were too early because the middleware wasn't there, the computing power that people would eventually have in the palm of their hand with their iPhones. So to finish the story, about 6 months ago, as you look at emerging technologies in aerospace and defense, they tend to be deep tech. They tend to be asset intensive, highly regulated, and that takes a unique type of investor as well. So we then partnered with Dennis Muhlenberg, the former CEO of Boeing, and created New Vista Acquisition Corp and New Vista Capital as an investing vehicle for these four sectors in emerging technologies. We went public in February of last year, and we are still actively looking for a target for our SPAC, but also working on private capital investing. So doing later stage investing, I'd say Series C and Series D investing for emerging tech in aerospace and defense. Hopefully that gives you a long span of kind of the multiple things I've done over my career.
I'm sure I'm not the only one in the audience thinking, wow, there is so much to unpack. I'll start from your financial background, and you clearly have the education, but also a lot of your career is based on finance and working for the best banks, the best companies that work in that space. How much of that makes you a better investor? And how much of that, especially I'm thinking early stage investment, where actually you don't have all the financial data like you would have for a public company. And how much of that could potentially bias you, where you could miss a good company because the finance is not as good as what you would like to see?
I think you bring up a good aspect. For early stage investing, certainly technical expertise and understanding the landscape and having a thesis on how the trends and area are going to evolve is more essential. And then you're making bets at those earlier stages. I think where the finance side can be very valuable is, for example, in asset intensive industries. And as those companies grow, helping them think about how they're going to capitalize themselves, as well as how they're going to capitalize their customers. That is a unique kind of value proposition that we bring to the table. And one of the things I know we're going to discuss is, look, you can be an investor, but you have to differentiate yourself. So how do you do that? Is it through your connections, your domain expertise, which is extremely important, your connections, your ability to help that entrepreneur network and leverage themselves? So what we've seen in aerospace and defense is that most of our entrepreneurs are tech, that they come from Silicon Valley. They don't necessarily have deep domain expertise in aerospace and defense. We can bring that in because of our deep connections in that industry. But the second part is this is an asset intensive industry, and how you sell these investments, how they are capitalized by your customers. Even in Solar City, if you look at how you capitalize service-based businesses, if you're not going to sell your equipment like an OEM does, but you're going to operate it, you need to think about your capitalization differently. So while it's not necessarily as important from an early stage perspective, it is important as you get to like Series A and Series B, because at that point you really need to have your business model more thought out and how your customers are going to acquire and how you're going to operate it. And I think what you want is always to be able to bring something differentiated to the table and help your entrepreneurial partner, your operating partner, think differently and be additive to his or her experience and background.
I think this is the first time of all our interviews where we have a zoom on capital intensive startups whose customers will also need capital. So I want to double click on this because I feel like there's a few golden nuggets here. How do you help the startup that you invest in to think well ahead of the game, to plan for their customers, to know how to capitalize?
It's a great idea. And we're having that balance in our industry. If you look at where the commercial aerospace industry is coming, you've had someone who makes the equipment and someone who operates the equipment, other people who maintain the equipment, and then you've got the customers. And as Boeing or Airbus or Embraer, you don't own the customer. Your customers are the airlines, but then the people who fly on that are over here. What I try to do to, again, create value and understand thematically where I want to go is take from other industries. So one of the things that has been incredibly successful is full stack companies owning the rails or owning the roads and bundling, right? So as we look at our industry, we've stolen concepts and ideas and business models and tried to apply them to our emerging technologies in space or emerging technologies in aerospace. As we have these new types of vehicles that come out, drones or passenger VTOLs or whatever they are, the combo of the two, how are they going to be operated and how does that look like? And when you're in the seed part of creating a company, you don't really need to figure those out. Sometimes in Series A, you don't, but you have to have a better answer when you visit investors. But by the time you really get to A and B, you've got to have figured out that business model. And of course, it all matters because every entrepreneur is asked about the TAM. So what is your TAM? And you need to define, am I selling my equipment? Or am I operating my equipment?
You mentioned you had a mentor, Charlie Walker. Can you tell us maybe one or two things that you learned from him that you still use today?
Charlie Walker and Nancy Fund, they were fabulous. And they recognized that it was an experience-based industry. And there's two different parts of being a venture capitalist. One, being a good investor. And then there's two, helping your company get to fruition and being a good board member and advisor, because that's effectively what you are. So in one sense, it's really an introverted, research-oriented, understanding trends and what's going on. But then two, to win that deal and then to work in a boardroom, The interesting thing about venture capital is it requires, like a CEO, multiple different skill sets that don't always fall within the same person. And they were both very thoughtful about laying that out and explaining how to do that. And they were incredibly about taking the time to spend time with the people they were nurturing to help bring up in the industry. And not everyone has time to do that. We joke about venture capitalists not always are the best managers, because sometimes to be a good investor and to be a good board member, it doesn't always mean you make time to mentor or nurture and develop the talent below you. And they both did a ton of that. I think you can never go back and not be appreciative of those mentors who gave you an opportunity to invest and an opportunity to make mistakes, and to not berate you when you make mistakes, because we all make mistakes. And it's how you handle those mistakes and how you handle yourself and take responsibility for those. And I hope I spend time doing that today, but sometimes in our busy world, we don't make enough time to work with people and help nurture their careers.
So tell me more about AirFinance. Not too much, of course, but enough to say what it is that in your design you were very thoughtful about to make sure you had, and what you thought was not important.
It's so interesting. So AirFinance provides asset-based financing to customers. We started with a partnership with the U.S. Export-Import Bank to provide U.S. companies, whether you're software or manufacturing, whether you're making MRI machines or services or aircraft, to help non-U.S. customers buy those products. We then partnered with other governments, the Canadian government, the UK government, the German, the Italian, to do the same for their domestic exports. So we spent a lot of time in emerging markets and a lot of time working with companies that have different cultures and different approaches. One of the key things we and XM also expanded into infrastructure financing. So roads, hospitals, as you build those in developing nations, but have tried to do is really look forward, thinking about where the U.S. industrial base is going. And again, it is a little more services than manufacturing. We want more manufacturing. We're going to encourage more manufacturing, but we're going to lean in a bit to services and what the U.S. sells. And how do we support U.S. companies, whatever they sell, even if it's not air, could be software, and provide support to those buyers outside of the U.S. to make sure that there's a level playing field globally, so that you're not competing against a Chinese company that is given with government support, so that your playing field is not equal. So again, I think that is something that in the industrial world, it's relatively well known and understood about how this support is available and how you think differently about asset-backed financing, hard assets, than you do. But in the technology world, it isn't. And I hope that we have a mindset as we think about the multiple, as venture debt has become more the norm than it used to be 10 years ago, that both asset-backed financing or services financing to support your sales will become another tool in your toolkit that entrepreneurs can use. Again, understanding about the competitive nature of things, what we've realized is, it's funny, when we started the business, back to your question, we thought our expertise was aircraft, funny enough. We thought we knew aircraft, this was what we did. And we realized what we knew is we understood about how to engage with government agencies and how to help emerging companies engage with government agencies, because there's a language difference, sometimes translating between those two organizations. This is why, in the end, our business expanded to not just aircraft, but outside of aerospace, but to really the areas that the government was interested in investing and what they cared about, taking our business in that direction and looking for and partnering with companies and help them partner. So that private-public partnership. But again, it goes back to, you've got to be flexible in this world. I encourage every entrepreneur to have a plan, to know exactly where they want to be in 5 or 10 years, but then they have to be able to adapt and adjust. And it probably won't look in 10 or 5 years like you thought it was. But if you can't adapt and adjust to the competitive environment and what you're seeing and what you're hearing from customers, then you won't be successful.
So let me follow on your last statement. It looks like aerospace is taking off, like a rocket. But you also mentioned you need to learn from the downsides, what happened in the past. However exciting it looks today, 5 years, 10 years, what it is that you're thinking about from what you've learned from the downsides. What are you doing differently than if you never had downsides in the past?
In any situation, you've got to constantly reassess what you've learned through a process and what you didn't know before. So for example, we know now what it takes to put a pipe together, and we're taking a very different approach than we did 5 months ago, finding an acquisition target and putting a successful pipe together. And I wish 6 months ago I'd known what I knew today, but you've got to adapt and adjust and take those learnings and make sure you disseminate that learnings and not adjust your path. With that, I think as having gone through a bankruptcy before or taken companies or having board fights, anytime that I think about how we structure things, either at a company we're working with or partnering, or looking at internal dynamics or how the industry is, you take those insights and you take those learnings on the downside that are invaluable. I know it's not very helpful. I can't remember, it was Nancy or Charlie once told me early on, you only really understand what every term in that underlying operating document or agreement is, and when you go through a liquidation or bankruptcy, because in the upside, you never see what those terms are. So that's when you really understand, oh, that's how that could protect me on the downside. We hate to go through them, but you're not going to be a good investor or good operator unless you've been through that.
I think I haven't gone through that, and I can feel that I'm going to learn the hard way about this.
It stinks.
Absolutely. The way I look at it very simplistically is sponsors decided to sponsor a SPAC without knowing exactly what it's going to be used for. But the PIPE investors, they know exactly what their money is going to be used for. So for me, the biggest proxy is really the PIPE investors. And then the worst signal, of course, is sponsors deciding not to leave, which would be really a disaster. But PIPE investors, for me, is really the signal that this is going to be a SPAC that's likely to be successful. I want to have a feel from you about, is it about checking who is the PIPE investors, or is it the size of the PIPE versus the SPAC itself of the sponsors? How would you tell people to look carefully at the PIPE to have a good, rich signal?
So, Nicholas, I 100% agree with your statement. However, I think because we're in such a difficult PIPE environment, it's not necessarily apropos anymore. So I said the same exact thing you said 5 or 6 months ago. I said, you want to follow the PIPE investors because they were the ones who were able to see some inside information and really get time with management and make some astute decisions. Unfortunately, I think that wasn't always the case because we had a hyped up market with a lot of retail investors who were bidding deals up. So most people understand that a SPAC is based upon $10 book and trust value. And then if it goes up to 12 or 14 or 18 or 30 in some cases, you basically get some frenzy around there. And as we've seen, and this may be a simplistic view, the Robinhood traders step away and the retail trade really pull back, you haven't seen the uptick in a lot of really strong deals. So it is no longer black or white anymore, and you have to be more discriminating. I've always felt that if you see a strategic investor, so corporate VCs in a deal, that is a big deal because that is also people who have hardcore industry and tech knowledge, and they are putting their money where the mouth is, and they can see the trends. I think the same as you've got some institutional, and it's an interesting question. I can't give you the answer. Once this bubble goes through, those overvalued deals that occurred in January and February go through the de-SPACing process, will there be money to refresh in pipes? One, we don't know that. We hope that there will be. But two, because deals are not trading up, what we're hearing from institutional investors is, why would I want to lock myself up for 4 to 5 months when I can just buy it in the open market at 10 or 9? I used to be willing to do that because it would trade up to 14 or trade up to 18. Yep. But if it's going to trade at 10, there's no upside for me investing in a pipe. So I actually wonder if SPAC 4.0, we joked that it was SPAC 2.0, maybe 3.0, whatever we're at, that the next version will include maybe less emerging companies. There were some companies that went public too early, and that was a problem. And it will include smaller pipes. You will not see that. So I would expect that you have lower expectations for round sizes and that you spend more time with investors really educating both SPAC sponsors and companies, really educating their investors and creating more reasonable valuations so that the redemptions are lower than we're seeing today. So again, thesis, as valuations come down, as we get more reasonable views, because you got the hangover, we will become a more normally functioning market.
Looking beyond the abyss. So I have one final question, which is not looking what you knew 6 months ago. What would you advise Kirsten 20 years ago?
That's a great question. I think the most important one is do something you're passionate about, because everything requires sacrifice. There are always other better things to do. And if you don't enjoy what you're doing, you won't make the sacrifice. I remember at business school, and I did to some extent make a wise decision. I was thinking about going to the hedge fund world because I really liked the markets and I liked investing, but I didn't love going through registration statements or S1s. That wasn't my passion. And I watched friends of mine who it was their passion. but I really love working with companies. And as I've talked about, I love diving into the intellectual curiosity of diving into a sector, understanding all the companies in there. That's something I would do in my free time. I would do if I were retired. So do something that doesn't feel like work. Do something you're passionate about, because you can do it for a lot longer and it doesn't necessarily feel like drudgery. So I think that is the number one thing. I would say that my last one is finding a job that doesn't require travel definitely allows you to have a more balanced life and family. I will say that. I have a job that requires a ton of travel. It's a global industry. It is so fun. You get to meet people. The aerospace industry is not one country focused. You got to be everywhere. But certainly if you're balancing a family, sometimes that is a tiny bit easier. So if I look at my software friends who are CEOs of software companies or tech companies, they don't have to travel as much. Definitely do something you're passionate about, because the rest will follow.
Kirsten, that was fantastic. We learned so much from you, and I love the way you're ending it with passion. Thank you.
Nicholas, I really enjoyed our conversation. You're an excellent interviewer, and I look forward to our next one.